Welcome everyone to Vested Interest. This is Shane back for another stock pick of the day video. It is Wednesday, August 20th. This will be a new one for me. I've never taken a look at this company before. It is a suggestion from Tanya Myers here, a subscriber to the channel. Can you cover MTDR and Voya? Well, we're going to look at MTDR today. That's Matador Resources Company. They are out of the energy sector. This is an oil and gas company. So let's jump in and take a look. Like I said, this will be the first time I've taken a look at this company. Had not heard of them before Tanya's suggestion here. And thank you, Tanya, for the suggestion. Now, before we get into that, go ahead and do me a favor. Hit that thumbs up button down below if you find any value in the content. If you are a dividend growth investor, make sure you are subscribed to the channel. The vast majority out there who are watching the channel are not subscribed. I think it's around maybe 20%, 10 to 20% of the folks that are subscribed to the channel are watching the videos. I'm assuming you're enjoying the video. So if you're watching and you are not subscribed, hit that subscribe button. Join us on this journey to financial freedom. Join the vested interest community. The channel continues to grow because of people like you. So a big thank you, big shout out to the subscribers of the channel. Really do appreciate all of you out there. And make sure you hit that notification bell so you're notified whenever we put out any new content. We do these stock pick of the day videos Monday through Thursday. Whenever the market is open, we take a look at a stock that's pulled back on the day and see if it is presenting any value. And to drop a comment down below. Let me know what you think of Matador. Is it one in your portfolio? Is it one you're watching? Is it one you had ever even heard of? Like I said, I had never heard of the company before, and I even lived in Texas where it seems to be located. So thank you to everyone out there who's taking the time to do that. Let's get into the stock screener here. This is how I set up the videos. We're going to run through this screener, see if it meets 5 of 8 or 6 of 9 if it was a financial company. Obviously, this one is not. But if it is a financial company like a bank or a insurance company, I like to look at price to book, utilizing 1 fair value, anything under 1 undervalued, anything over 1 overvalued. Price to book can be used for any company, but if it is outside the financial sector, make sure you are comparing price to book for that company you are looking at compared to other companies in the same sector, in the same space, right? So an industrial, for example, a company out of the industrial sector like Union Pacific, which is a railroad, you would compare their price to book to other companies in the railroad, like maybe a Canadian company or one of the other many railroads out there. Don't just blindly use the one as fair value for all companies. It doesn't work that way for companies outside the financial space like banks or insurance companies. Well, we're going to run through the screener. We'll see how it stacks up at the end here. And let's get back over to Matador Resources, www.matadorresources.com. That is the homepage where I pulled this information from. That's www.matadorresources.com. That is their homepage. And Matador is an independent energy company engaged in the exploration, development, production, and acquisition of oil and natural gas resources within the United States, with an emphasis on oil and natural gas shale and other unconventional plays. Its current operations are focused primarily on the oil and liquids-rich portion of the Wolfcamp and Bone Spring plays in the Delaware Basin in southeast New Mexico and West Texas. Matador also operates in the Eagle Ford Shale play in South Texas and the Haynesville Shale and Cotton Valley plays in northwest Louisiana. Additionally, Matador conducts midstream operations in support of its exploration, development, and production operations and provides natural gas processing, oil transportation services, natural gas, oil, and produced water gathering services, and produced water disposal services to third parties. So oil and gas primarily, but also looks like some water disposal services, probably around the oil and gas industry as well. And here you can see, I like maps. So as you can see, southeast New Mexico and West Texas, that'd be this out here in the blue, the Delaware Basin, South Texas, down here, the Eagle Ford Shale and other formation, and northwest Louisiana, Haynesville Shale, Cotton Valley, and other formations are over here, right? And I did used to live in Dallas. Actually lived in Ennis for a while. I got a lot of family down in Texas. My mom is from Texas, actually. So again, www.matadorresources.com if you want to check them out at their homepage. Now, the reason we are taking a look at them today, down to 2.08% on the day, closed the day out at $55.91. We are talking about Matador Resources Company, ticker MTDR, out of the energy sector. This is an oil and gas play here. 52-week range as low as $50.79, as high as $71.08, and they are within 15% of a 52-week low. I think anything under around $58 per share would keep you in the, I think I did the math here, would keep you under 15%. Let me see if I can do the math real quick, or if I did what it was. Here, let's look at that. 50.79 times 1.15. Yep, $58.40. So you need to get them under $58.40. That's within 15% of 52-week low. So they currently do sit in that range. Market cap of $6.97 billion. Small cap company here. Beta of 3.30. Very volatile company, right? That's high volatility. So you might be able to use this to your advantage. These big swings, and you're going to see big swings with this. 3 times the volatility of the overall market. Try to be buying on those downswings, right? As it starts to pull up, back off, but you can definitely use the volatility to your advantage. If you're investing in this one right now as one of those down swings, might be have recovered a little bit from the very bottom, but still on a downswing here. PE ratio, $7.20 per share. Very low PE, but you'd want to compare this to other companies in the same sector. A lot of times they are lower. EPS, $7.77. One of the few times EPS is above PE ratio. Earnings date, October 22nd through October 28th, somewhere in that window. Forward dividend is 80 cents. I believe they are a quarterly payer. We'll see that here towards the end with a very low starting dividend yield, 1.4%. But that's pretty close to in line with the overall market. If you were to buy like the S&P or VTI, which is what I invest in, that's pretty close to what you're getting for a dividend yield. Ex-dividend date, August 15th. So we just went past that. You would not get this September 5th payout. Even if you were to buy them today, you need to buy the day before the ex-dividend date. So if you see ex-dividend date, don't buy it on the ex-dividend date thinking you're going to get the dividend. You want to buy the day before. So you should have been buying this on the 14th or before. We are just 5 days past this right now. So if you were to buy them now, you're waiting 3 months after September 5th to get the next dividend payout ratio. Excuse me. Now, Yahoo Finance has a one-year target estimate of $79.93. Looks like they expect it to set a new all-time high here, or 52-week high anyway. I don't know if it's the all-time high, but it definitely would be a new 52-week high. And I am pulling this information from Yahoo Finance. I am not affiliated with Yahoo Finance. Just one source I like to go to for information, and I always recommend more than one source. So we'll look at some information from stockanalysis.com here in a second. Now we're going to jump over here to the right. We're going to look at the 5-year dividend yield average and compare it to its current. That is what we're looking at to see if it is undervalued according to dividend yield theory. So dividend yield theory works. You look at the 5-year dividend yield average. Unfortunately, this company doesn't have one. But let's say it was 1.5. You would compare it to 1.4. That would speak to overvaluation. They're inversely correlated. So you look at the current 1.4 versus the 5-year. If it's above the 5-year, that would be undervaluation. If it was below, that would be overvaluation. Unfortunately, we don't have 5 years of payout to look at. So you could use the trailing annual dividend yield of 1.31%. That's at least covers whatever it was the previous few quarters. And say it currently sits above the trailing dividend yield, which would still be potentially undervalued, but that we don't have 5 years. So again, that is one way to look at it if you wanted to use dividend yield theory. You just don't have 5 years to look back at. I like the 5-year average. So we're not going to give them a check, even though if you use the trailing, it looks like they're potentially undervalued. I like 5 years, so I'm going to treat this one just like any other company I review. Now, I do like this. Payout ratio, very, very low, 9.65%. So they have a lot of room to increase the dividend, pay down debt, make acquisitions with the oil and gas plays you want to be doing, whether they're buying somebody out or building their own new drills, drilling spaces, building more pipe to transmit oil and gas, whatever they're doing with their funds. They have a lot of room to continue to do that. The dividend is more than safe and more than covered. Plenty of free cash flow left out there to pay the dividend, pay down debt, and do whatever else they want to do. Going down, we're going to take a look at free cash flow. We want growing free cash flow over time. Typically, if a company has growing free cash flow and growing dividends, or they'll have growing dividends to go along with it. You also want free cash flow to make sure that the dividend remains safe and the company continues to grow over time, pay down its debt, do everything it does needs to do as a company, make those acquisitions, buy back shares, if potential, pay down debt, those sort of things. So going to 2020 here, you can see negative free cash flow, negative $302 million. That's not good. I don't like to see that. 2021, though, up positive $319 million. Big turnaround there. 2022, even more of a jump, $894 million. And 2023, even though it looks like free cash flow was way down, look at the repayment of debt. They jumped way up, over $3 billion repayment of debt. So I'm going to say their free cash flow is only down because they took a big old chunk of it and paid down some debt, which is very good to see. They're not repurchasing shares, it doesn't look like, but I really like this. Now you're going to want to compare repurchase of or repayment of debt to the issuance of debt, because if they issued, $4 billion in debt and only paid down 3.2, then obviously they'd be taking on more debt than they were paying off. But I like to see that, and it definitely accounts for the drop in free cash flow, more than accounts for it, really. Now we're going to jump over to stockanalysis.com. Like I said, I always recommend more than one source so you make sure the information you are getting is accurate and up to date. And some sources have more information than others. Now they have 12 analysts that have taken a look at this. They actually call it a strong buy. So that means the majority are either calling it a strong buy and a buy. But if you were to go to their webpage, you could see if any of the 12 were calling it a hold, maybe a sell, or a strong sell. This being a buy, strong buy. Going to the website gives you a little bit more information and breaks down how these 12 analysts see it on an individual basis. It might be 4 or 5 that call it a strong buy, 6 or 7 that call it a buy, maybe 1 or 2 call it a hold. I did not look at that, but you could do that if you wanted. Now, they do have a low estimate of $62. It currently sits 10.54% lower than their lowest estimate. Average estimate of $78.50. That's pretty much in line with what we saw with Yahoo Finance on the previous page. That would be a 39.95% increase. And if it happened to hit their high, 58.67% increase, $89 per share. I do think that this one could get back up, like I said, to at least its 52-week high and surpass it. I think Yahoo Finance had it at 79, so that'd be a heck of a jump up, 39%, 40% gain, even with a low dividend payout. That would be a very nice return. Now we're going to jump into statistics. I like to look at return on equity and return on invested capital, like 10% or better for these numbers. This tells you how efficiently the company is reinvesting back into itself. Return on equity sitting at 23.96%, so very good there. Return on invested capital, 13.69%, very good there, both above what I'm looking for. Now they didn't have EPS growth forecasted, and it is the oil and gas play, so you're going to have to decide, for yourself how much you believe in a transition to EVs, how much you think oil and gas is going to remain around. Personally, I think it's going to remain around my entire lifetime and probably most of my kids in some form or fashion. Maybe not as much as it is now, but we will not get off oil and gas completely in my lifetime, I do not believe. Let's jump back over to the dividend history here. Quarterly payout ratio very low. I think we saw 9% from Yahoo Finance. They're saying 10.3. Either way, extremely low payout ratio. Now, very, very fast dividend growth. This is smoking high, 45.45%. Now, I don't know how long they can maintain that growth, but boy, oh boy, that's some beautiful dividend growth. Kudos to any of you out there who have received those type of dividend bumps, dividend pay raises over the last 3 years. Looks like they've been growing it for 3 years. Buyback yield of 0.95%. So they must have bought back some shares here over the last 3 to 5 years. Shareholder yield of 0.47%. Looking at their dividend history going back to March 2022, you can see they were paying out a nickel, jumped it up to August 2022 to 10 cents, 15 cents in February 2023. Looks like 5 cents a pop here. So I would anticipate another raise here before it jumped up in November 2023 to 20 cents, and they've maintained it there since November of 2023 at 20 cents. So I would anticipate November probably getting another bump up in the December payout being 25 cents. If they're going to keep it the nickel bump a time, that's what I would anticipate. Very, very fast dividend growth. That's smoking high. Now back to the stock screener here. You can see we started with understand the business. Check there, growing free cash flow. They're an oil and gas company. Growing free cash flow. Yeah, I'm giving them a check. I said that one year that they dropped from 2022 to 2023, it looks like the free cash flow drop actually went to pay down debt. So it wasn't necessarily that they didn't have the free cash flow. It's that they utilized it to pay down debt. And when a company does that or buy back shares, I include that whenever I look at the overall free cash flow. Growing dividend, yes, growing over time. Smoking high growth, over 40% growth. This is a fast grower. Like I said, I don't know how long they'll keep it up, but boy, that's smoking fast. Dividend payout ratio of 75% or less, yes. 10% or lower, really, 10 to 9%. Check valuation based on dividend yield theory. Not enough data there. Like I said, you can use trailing to kind of give you a gauge of what it's been, how cheap it is over the last few quarters or something. But we don't have 5 years of data to look at dividend yield theory the way I like to. Buy below current cost basis, so within 15% of a 52-week low. It is within 15% of a 52-week low. It is not in my portfolio, so it can't be below my cost basis. Return on invested capital, return on equity, both over 10%. Did not have anything listed for the earnings per share growth forecasted over the next 5 years, and it wasn't a bank, so we didn't look at price to book. So 1, 2, 3, 4, 5, 6. Yep. It makes 6 of 8, so it definitely would go on my watch list. I am going to add it to my watch list, do more of a deep dive into the financials on this one. Interesting company, very, very fast dividend growth. Even if you got 2 or 3 years more of 45% dividend growth, boy, oh boy, that's something else. Well, let me know what you think of Matador in the comment section down below. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Drop a comment down below. Let me know what you think of the video. Let me know what you think of Matador. Is it one you're adding to your watch list? Is it one in your portfolio? I do personally read and respond to the comments. I am always interested to read your questions, opinions, or suggestions for future topics. So if you have a suggestion like Tanya's here, drop it in the comment section down below. I'll work it in the rotation. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in, and we will see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can lose money, so never invest any amount you're not comfortable losing it. Always do your own research. Invest based on your situation, circumstances, and selected criteria, or seek the advice and counsel of a certified financial advisor.